Welcome to the deep dive. Today we're tackling something called required minimum distributions, RMDs for short. Sounds a bit technical, maybe?
It can seem that way, yeah. But they're really, really critical for anyone with retirement accounts.
Right. And we've got some materials here from Diversified Insurance Brokers that folks shared, so our mission really is to break this down.
Exactly. We want everyone listening to feel comfortable knowing what RMDs are, when they kick in, which accounts we're talking about.
The potential pitfalls, like penalties, and maybe some basic ways to handle them.
That's the plan. Make it clear and actionable.
Okay, let's jump in then. First things first. What exactly are RMDs?
So, think of it like this. The government lets your retirement savings grow tax-deferred for years, right?
Mm-hmm.
Well, RMDs are basically the government saying, okay, time's up, we need to start taxing that money. They're mandatory withdrawals you have to take each year.
Mandatory. Okay. Even if I don't actually need the cash right then.
Correct. Doesn't matter if you need it for living expenses or not. Once you hit a certain point, the withdrawals are required. We're talking mainly traditional IRAs, 401ks, 403bs, those kinds of accounts.
Got it. So tax-deferred accounts, when does this mandatory clock start ticking? What's the age?
The magic number now is 73. So your first RMD generally needs to be taken out by April 1st of the year after the year you turn 73.
April 1st of the year after 73. Okay.
Right. And then for every year after that first one, the deadline is December 31st.
December 31st. Okay, 73 is the trigger. You mentioned traditional IRAs, 401ks, are all retirement accounts subject to this?
Mostly, yes. Most tax-deferred plans fall under these rules. But there's one really important exception.
All right, which one is that?
Roth IRAs. At least during the original owner's lifetime, Roth IRAs don't have RMDs for the person who opened them.
Ah, okay, that's a big difference. So traditional types, yes. Roth, no R&Ds for the owner. Good to know.
Definitely a key point for planning.
Now, you mentioned penalties earlier. What happens if someone, forgets or just doesn't take their RMD?
Yeah, you really don't want that to happen. There's a pretty hefty tax penalty if you fail to take the required amount. The IRS is serious about these rules.
Okay. Hefty penalties sounds like something to actively avoid. So how do they figure out the amount you have to take out? Is it just a random number?
No, there's a formula. It's basically calculated using two main things. Your account balance at the end of the previous year.
Okay, last year's balance.
And your life expectancy based on standard tables provided by the IRS. The idea is sort of, to spread the distributions out over your remaining expected lifetime.
Balance and life expectancy. Okay, makes sense conceptually. Don't need the exact math right now.
Exactly, just the principle.
What about this, though? What if someone is, say, 74 but still working? Does that change anything?
That's a really interesting scenario, and yes, it can. If you're still working and actively participating in your current employer's retirement plan, like a 401k, you might, emphasis on might, be able to delay taking RMDs from that specific plan until you actually retire.
Oh, really? Just from that company's plan?
Correct. But, and this is important, it depends entirely on the specific rules of that employer's plan. You absolutely have to check. And this delay usually doesn't apply to your traditional IRAs. Those RMDs would likely still start at 73.
Okay, so check the specific plan rules if you're still working past 73.
Got it.
Now, when you take these RMDs out, is the money taxed?
Generally, yes. Because the contributions and earnings in these accounts grew tax-deferred, the withdrawals, including RMDs, are typically taxed as ordinary income in the year you take them.
Right, deferred, not tax-free forever.
Okay.
So knowing they're taxable, are there ways to be, strategic about it, to manage the tax hit?
Absolutely. This is where planning really comes in. You don't just have to take the bare minimum and pay the tax.
Like what? What kind of strategies?
Well, for one, some people might look at their overall income picture and decide if taking a bit more than the RMD in certain years makes sense. Maybe if they expect to be in a higher tax bracket later.
Interesting.
Another common strategy, especially for those who are charitably inclined, involves something called a qualified charitable distribution, or QCD.
QCD, right.
Yeah, you can potentially satisfy your RMD requirement by donating directly from your IRA to a qualified charity. That amount isn't included in your taxable income, which can be a big win. It's all about looking ahead and planning your retirement income streams.
So options exist beyond just taking the cash. That's good. Why is Why is getting a handle on all this RMD stuff so crucial for our listeners?
Well, fundamentally, it's about avoiding those substantial penalties we talked about. That's number one. But beyond that, understanding the rules lets you plan proactively.
How?
It means you can make informed choices about how and when you take your retirement income, potentially manage your tax liability throughout retirement, and ultimately keep more of your hard-earned savings working for you, rather than just, going straight to taxes unnecessarily.
Right. It's about staying compliant and being smart with your money. Okay, so let's try to wrap this up. Key takeaways.
Yeah. RMDs, they're mandatory withdrawals. They generally start the year after you turn 73 from tax-deferred accounts like traditional IRAs and 401ks.
They're not Roth IRAs for the owner.
Correct. Missing them leads to penalties. The amount depends on your balance and life expectancy. And importantly, these withdrawals are usually taxable.
And knowing these rules helps you avoid penalties and plan better for taxes in retirement. Okay, so maybe a final thought for everyone listening. Given all this, what's maybe one small step you could take right now just to start understanding how RMDs might fit into your own financial future?
Yeah, just thinking about that first step is key.
It really is. It's all about getting informed and planning ahead. Thanks for diving deep with us